Hey everybody, welcome to Trading Capital Exclusive Analysis. In today's video, we're going to be discussing the major indices, some individual stocks, gold, Bitcoin, the energy market, and basically what we need to prepare for next week. So next week we have a whole host of economic data, and overall the markets have been in a little bit of a technical downtrend just in the short term. So short-term downtrend, medium and long-term technical uptrend at this point in time. Let's jump over to the SPY, the S&P 500. You can clearly see the SPY hit its first level of technical support. So you had one pivot zone here, multiple pivots over here. This is your breakaway gap. You have not technically filled the gap, but you're inside of this gap window, which likely means that the markets, due to the fact that they are slightly oversold in the short term, could see a little bit of a bounce coming in the next few sessions. And it's really going to be dependent on the data. Does the data come in positive for the economy next week, which therefore spikes yields and causes more pressure on, say, technology and financials? Or does that data come in with the Goldilocks zone where it kind of keeps yields a little bit more suppressed and therefore allows tech to get that inevitable short-term bounce that I think is coming very, very close. So overall, the S&P, you would favor a technical bounce off of this level. The bears did slightly defend it, although the market did finish down on Friday minus 0.16%. When you look at the weekly chart, everything is still technically okay, other than the fact that you are still slightly overbought. I still have it priced in that on a weekly chart basis, we should see this support at some point, but it doesn't mean we can't have a few day bounce before we start to trend lower. You know, if you look at the short-term weekly 20 moving average, we're still very, very extended from this blue moving average, which I think is going to be a pretty decent technical support level if the markets pull back to that level. All right, let's move along to the QQQs. So the Qs have actually been relatively weak. So funny enough, the Qs were the strong indice leading the charge to the upside, outperforming the IWM and the SPY. But overall, the Qs have now been relatively weak. So the spiders, the SPY is basically holding support right around this equivalent pivot, but the Qs are trading well below that. So why is it important to track the Qs? Well, the Qs carry the most weighting in the indices, you know, the likes of Apple, Microsoft, NVDA, Google, Meta. Those bellwether stocks that has ultimately been lifting this market much, much higher have a much higher degree of weighting in majority of the indices and some of the actual ETFs that we trade. But needless to say, I think the Qs are going to get a retest back to this resistance. So whether or not we get a gap down and then reversal on Monday, I think that the very minimum, the Qs are going to retrace back to this 372. So call that a $4 to $5 point move up in the coming sessions. That's what I'm expecting at the minimum. And then we really have to watch for a type of pattern that could be developing. So this is your, let me just remove this. This is your neckline. If for some reason we come up, you know, and develop this right shoulder like this, if you lose this neckline, then it's basically looks like the downtrend is going to resume. However, as long as you trade and hold this neckline, the market is still in a very strong technical uptrend, and you want to favor the upside continuation. So really watch for a right shoulder development this next week. You know, basically if we look at this shoulder development, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, about 12 trading sessions. So just under 2 weeks of trading to develop this left shoulder. So from 2 weeks from basically this August 13th would put us, you know, all the way back down to really close to the end of the month here around August, beginning of September. So pay very, very close. Now don't entertain this pattern until we get a daily close below this key white neckline. But until then, I think at the very minimum, we're going to see a bounce back up to this 371 on the QQQ. All right, let's move along to the IWM. So the IWM has just been trading in this wedge pattern. You did have a breakout on the daily chart of this downtrend as seen by here, but often the price action likes to retrace back to that downtrend. So I think that if we get a retrace back into this vicinity where it retraces back to the breakout trend line, and it simultaneously hits these pivot zones, I think that's a decent area to potentially go long some small caps. But until then, we just have to wait for more clarity on the Russell. You know, you have to be very, very careful with the IWM, especially when the rates are moving higher. So if we look at the 2-year yield, and more importantly, the long end yields, which I'll just pull up here. If you look at the 2-year yield, it had an epic epic, almost look like a failed head and shoulders pattern here. Here you have your left shoulder, your head, your right shoulder. It dipped below there, looked like it was going to break down, and then nope, it just went right back up. So we have to be very mindful that this could be a failed bearish pattern turned bullish, and ultimately if this turns bullish, which I think it has a strong chance to do so, you know, you could see some sort of an up move, just like you had over here. You had this left shoulder, you had your head, you had your right shoulder. It was kind of teetering on this neckline trigger. I remember where you triggered it here, sucked in a lot of people on the long side of bonds, and then look what happened to the bond trade. I mean, yields just started skyrocketing from there, and had you taken that bond trade, you would have been significantly underwater on that single trade. So be careful with yields, because this technical weekly uptrend is very, very strong, and it actually looks like it wants to break out to new highs. And let me just point something out to you that is very, very interesting, especially on the long term, the US 20-year. So a lot of people trade TLT, which is the bond of the 20-year. So if we look at the yield, the 20-year yield, what I was doing some symmetrical moves and working out this long-term channel. Here we have this long-term weekly channel that yields have really been trading in on the 20-year yield, where you hit your pivot high, pivot low, kind of the center point of the channel, pierced the channel here, had a pullback to the center, kind of just kissed the low end of the range, and now it almost appears that you want to break out of this downtrend. I mean, take a look at this weekly breakout. Here you have a weekly breakout, and it's going for a confirmation on the upside. So if you confirm this weekly breakout, you know, there's a certain probability, not the maximum probability, but there's a high enough probability that this could actually cause a breakout in the yields to head to 5.63%. And this isn't a breakout on the short-term curve. This is a breakout on the long-term curve. So what that means is bond traders likely will be pricing in inflation being entrenched, and this CPI headline that we just upticked last week could continue to make its way to the upside. So again, a measured move. If you take this low to this high, basically it's the same measurement from this low to this high, and it would hit the exact same, pretty much the top of the channel that has kept you in check, roughly putting you at 5.7 on the 20-year. I mean, if you're at 5.7 on the 20-year, what does that mean for stocks? More importantly, time will tell, but I certainly think it could be very, very troublesome for stocks. Let's move along to gold. Gold on the weekly chart, triggering a bearish breakdown. This is a weekly breakdown of an uptrend. Basically, what I'm looking at now is potentially a trigger of this head and shoulders on gold. So you have this left head, right shoulder, boom, you've triggered the neckline. Well, I stand corrected, you have not triggered the technical neckline here, but it's very, very close to doing so. Actually, you did trigger it on the weekly chart, which is very, very important to pay attention to, because if gold is triggering this weekly breakdown, and if we can believe this weekly breakdown, it sends gold back down to the low or the high 1600, 1689, back to this breakout wide range green candle. And more importantly, if gold is breaking down, we have to remember that during this last rally, gold was leading the stock market, leading the S&P before the stocks rallied. So if gold is now breaking down, what does that mean? Is that inflation really going to be coming back? Is the dollar about to get a bullish breakout to the upside? Certainly this pattern is suggesting a breakout on the dollar. The fact that there's a couple things I want to point out here on the weekly chart of the dollar. So one, you got a weekly close above this neckline. That has negated the bearish breakdown. Two, you also got a weekly close above this nasty wide range red bar breakdown. So that leads me to be much more bullish on the dollar, which likely means that inflation is going to be entrenched, and we're going to continue to see inflation rearing its ugly head. So this head and shoulders that broke down, sent people bearish on the dollar, has now been negated on the daily and the weekly chart. And again, the biggest moves come from these failed patterns. So since this pattern did not completely play out to the upside and you're getting a bullish reversal, this stands to suggest that the dollar is likely going to at least test this pivot high at 105.90, 106, and then we'll have to reassess from that point on. But if the dollar continues to, get above that 104, on my calculations, anything above 104 on the dollar, we'll just mark that in with this simple dotted line. Anything above 104, that's when emerging markets really start to get squeezed again, and it's where the US is starting to export their inflation to those emerging markets. So we have to be mindful that a large portion of the S&P 500 earnings come from emerging markets, and I think it's roughly 30%. So that could certainly put a drain on some of these mega cap companies. Remember some of the markdowns that Microsoft, Apple, and these larger corporations had when the dollar was surging higher. So we also have to take that into account in their future earnings report. Let's say we have a 3-month rally in the dollar, that's going to greatly negatively affect the earnings of some of these larger companies, especially when they do business abroad and have a large chunk. All right, let's move along to see what else is transpiring. So I'm just going to pull up the Bitcoin chart and then the oil and natural gas chart. So Bitcoin, basically nothing has changed on Bitcoin. I actually remains more optimistically bullish on Bitcoin. Reason being, there's a couple key things that I want you to pay attention to. So Bitcoin, let's go back to this pattern over here. Bitcoin had this head and shoulders pattern that triggered. It never fulfilled its downside move, or actually it came very, very close to. So we'll call it that it did. But Bitcoin has basically broken out above this key trend line. You can see your pivot, your pivot, your pivot. This is your breakdown, retest, failure, breakout, consolidation. Bitcoin is now back below that key neckline. If Bitcoin can get above this original breakdown neckline, it's going to make a new high in this cycle. So I still have it pricing that Bitcoin gets to about 32.6, maybe even 33,000 on an optimistic push before it has a bigger rollover to the downside. So I'm actually long some crypto stocks, full disclosure, at this point, like Coinbase especially. But needless to say, this looks healthy. You've had a little bit of a temporary breakout, retest, consolidation, still holding this lower boundary breakout range, but still technically below this key resistance. I think since we've tested it once here, tested it twice, I think the next push-up actually breaks us through that range and really sends us to test the previous cycle high in this Bitcoin range. So I still think there's one more run up in the overall Bitcoin price, but that could be kiboshed, especially if the dollar does get through this level with some pretty sharp revenge. And one thing you have to pay attention to on the dollar at this point in time is the fact that it could also be developing a little bit of a head and shoulders or an inverse head and shoulders pattern. And what I mean by that, if you don't see it, is you have this left shoulder, you have your head. This is a little bit of a premature right shoulder, but you can still technically say it has broken out. And let's just say that this pattern has broken out right now as of the Friday close. You take that measured move of the neckline, and I mean, we're looking at a move all the way up to about 106.22 on the charts. That's a pretty big rally for the dollar that's looking very, very likely to happen at this point in time. All right, let's move along to natural gas, and then we'll discuss oil, because the energy side of the component in the CPI is very, very important to pay attention to. Natural gas has had a breakout out of this bullish flag here. You've had a retest of the top end of this range, this beautiful parallel range, and the bulls were actually able to hold basically that high end of the range as of Friday. So I still would like to see a retest to this 265 before I go long again. My members were able to sell pretty much at the $3 gap fill mark to bank a nice profit on UNG, but I do think we get a retest lower at 267, and then I think it's basically uphill from that. I really think that, if we get a retest, that is the entry on the long side for natural gas if you have missed this trade. And then I think the next stop is 330. And then honestly, this gap fill, that has to be filled at some point in time. And I do think that, over the next 6 to 12 months, it has a very strong likelihood of doing that. All right, WTI. And it's interesting to see energy markets breaking out, holding a short-term technical uptrend, as we're also seeing rates break out. So, I think rates are kind of having to front run this energy trade, because if you let this energy trade get out of hand, it's going to make inflation worse. So let's remove that channel. Basically, you can see your downtrend since the Ukraine-Russia highs. You clearly broke out of that downtrend. It's even more evident on the weekly chart. You got a 1-week candle close, 2-week candle close, and now it looks to just be putting in some sideways consolidation. Let me be clear. If the oil gets above this $84.70, $85 mark, you're going to be testing this $93, and that's a pretty big jump in oil. That would be a pretty big jump in the year-over-year comps for the CPI, and that would send rates much, much higher, especially if that energy front of the inflation print starts to get out of hand, which is notoriously what history has actually shown us. All right, let's move along to see what else we're going to show. I'm going to pull up another chart here just to show you what I'm looking at, but basically, This is a view of some of my other software that I have been looking at. Let me just bring in the screens. So basically we're looking at a 1 week view of the S&P 500. So first thing I want you to notice on the S&P 500 here is that you had 200 stocks up on the week, but you had 231 stocks down on the week. And what's interesting is when you look at some of these stocks that were down in the week, at the bottom of this, NVDA down 8.56%, Qualcomm, LCRX, the semis are starting to lag the market. AMD, whenever you start to see the semis or these bellwether stocks lag the market, even Harley Davidson has been a bellwether stock. That's never a good sign for the market. You look at where the strength and weakness was on the week. You had basic materials down, most of them are down. You had consumer cyclical, most of them down. Financial services, most of them down. Consumer defensive, technology a big loser. Industrials kind of mixed. But arguably, you have a lot of important names that are showing some signs of weakness. And then you look at healthcare, Eli Lilly, Valero, the energy trade has been spectacular. So there are some pockets of strength, but there's certainly some pockets of weakness showing up. And maybe it's just overbought profit taking in some of these names that have run up a little bit too far too quickly. But when the bellwether stocks like NVIDIA, Harley Davidson, AMD, and a variety of these other names start showing weakness, just use caution, because it could certainly, their valuations could certainly be cut by a tremendous degree, especially if rates continue to break out and make new highs in the cycle. Even if you look at the NASDAQ 100, if we scroll down to this list of stocks, so there's quite a bit more, but you can see that in the NASDAQ 100, 529 stocks were up on the week, 907 were down. That is a big, big sea of red out there, and you want to be paying attention to this breadth, because again, more profit taking could lead to more profit taking, and it doesn't take long before panic starts to set into the market. On that note, I'm going to end this video here. Please give this video a big